Hello everyone and welcome to our lecture number 13, workshop number 4, which explains the well-known stop loss method that everybody knows. Everybody knows how to use a stop loss, but where we're going to focus today is stop loss day trading style. And day trading style in particular, we would like to talk about scalping, a very well-known method that everybody who is keen in day trading or spend time in day trading knows about it, and it's just a matter of being able to implement it efficiently and skillfully. It's a little bit of a skills required here for you guys to be able to take advantage of scalping. A lot of people make mistakes because they don't do homework in advance and they don't really know what a scalping means and how they can use a stop loss in order to scalp those few pennies on top of those explosive stocks. So for folks who are interested in day trading, I really encourage them to watch this video to the end. Hopefully we'll be able to teach you guys some instructions and some techniques in order for you guys to be able to scalp a few cents and pennies off of stocks that have uptrend or downtrend alternatively, and hopefully you'll get something out of this video. So stay with us till the end of this video and let us explain the details to you. We will go to our favorite trading platform, Thinkorswim. We explained the last workshop, the advanced orders, OTO, OCO, how you can place it, how you can execute it. Pretty much we're going to do the same thing with OTO, OCO, but instead we will focus on the stop loss. Usually when we talk about a stop loss, the first thing that occurs to your mind is a stop loss. So the name suggests that it is a method by which you stop further losses. Basically, when you buy something, buy a stock, say you bought Apple here, I got Apple here, I bought Apple, and I want to make sure that I don't lose by putting a stop loss on it. So traditionally, folks will go on it and place a sell order on their position, sell Apple, say 100 shares of Apple. Then they go here in their setting and they say sell 100 shares of Apple with a stop, and they say, for instance, stop limit in this case, because they want to have control over the price at which their position gets sold. Stop limit. So they say if Apple goes below $155, stop. You got to be careful, Mr. Broker. If Apple goes below $155, then at a limit of $154.80, sell my position. So that a trigger signal will send to the broker once the stock surpasses, or in this case, plummets below $155. The trigger signal is sent to the broker, and then at $154.80, the position gets filled. And it makes sense. It is intuitive. So it is a stop loss. So you have a position, you want to sell it, and you want to stop further losses. If you place this position on your Apple stock right now, which is traded at 157.8, what happens is that if you go to the graph, you will see, let me bring Apple here. You'll see that, yeah, there's this line here that says Apple gets sold 100 shares at $154.80, but the trigger point will be sent to a trigger signal will be sent to the broker at $155. That's a good thing about the stop loss order. Majority of traders, especially newbies and novice traders, they know this sort of stop loss implementation execution. What they're not aware is that a stop loss can be also used for purchasing the stocks, for buying the stocks. Even though the name is a little bit counterintuitive, when you say stop loss purchase, what do you want to stop? You haven't even bought anything yet. But stop loss purchase or stop loss purchase of a position buying is used for explosive stocks, for the same technique, but with a different meaning is used for a stop loss buying a position. And let me show you that with a practical example. So I'm going to cancel this order, and I'm going to close this. I'm going to go to monitor. What I'm going to do here, I have here $87,000 option buying power and basically buying power. My option buying power is my cash, is my buying power. I want to find a relatively cheap stock so that you can buy 1,000 shares of it, and then or maybe 5,000, maybe 10,000. So I'm looking around. I'm looking for a stock around the range of anything between $2 to $10, or maybe even $15. So see, what I can do is to go to the scan and look for the stocks between, let's say, $2 and $15. I want to be able to make profit. So the reason I'm picking a cheapest stock is because I want to be able to buy at least, say, 5,000 shares, 2,000 shares, 3,000 shares. Reason being is I'm going to scalp pennies off of a stock, and pennies, we're talking about 3 cents, 4 cents, 5 cents. If I buy only 100 shares times 5 cents, that is nothing. That is peanuts, because my commissioning fees is $8 or $9 purchase, $8 or $9 basically selling, and then in total I'm paying $20 worth of commissioning fees. I don't want to make $50, and I don't want to make an effort to make $50. Out of which $20 should be paid against commissions. What I want to do is I want to make at least $500, $1,000, and then if I pay $20, that's peanuts to me. So if I buy 10,000 shares, if I buy 5,000 shares, I'll make enough money scalping 5 cents that will be worth my time. My time and effort placing all this advanced orders, and commissions will be deducted from it. So I'll pick, given my money, which is 87 grand, I'm picking stocks between $2 and $15. What I will do is that I want to make sure that I will deal with the stocks that have high volume. If anything between 500,000 to a million trades being placed since this morning, because those popular stocks are traded heavily, and those popular stocks usually explode in a matter of seconds because folks are trading it very avidly, and then they're waiting for the right moment to get in, and that's the right moment you and everybody else, all those day traders, should be ready to get in. And that's all day trading is all about. You want to wait for the right moment to get in through an explosion of a price, the stock, when it goes up. And then I want to make sure that it has a percentage of change, anything more than 3% since yesterday, which is a signal for uptrend movement. If it is less than 3%, less than 2%, essentially it's a dormant stock. It's not making a lot of move. And that is why I want to make sure that it's more than 3%. I don't care about the fundamentals, so I'm going to try. So the fundamental filter that I had since last time I taught you guys the fundamental filter, what I want to do is that I want to remove it. I can just simply put a 0 for minimum, basically giving me everything that there is out there. So I'm going to scan it, and these are the stocks that I can find. So you can see that on the top I have these stocks with highest percentage of change. Let me filter that for the highest. All right, so this one says DGLY, Digital Ally Incorporate, whatever, and I don't know what that company is. 19% change since yesterday. It used to be it's right now $3. So let's find out what it is. I'm gonna put it in my watch list, DGLY, and then I can see that it has gone up 50 cents, which is 20% increase. Let me see its graph, its chart, or candlestick price chart, DGLY. As you can see, This was the price yesterday, and this has gone up tremendously within a matter of seconds. Volume has peaked here, and this could be a stock that I can pick for my day trading. However, just for your information, the massive volume, massive trades has been already done for this stock. So the volume is going down. Then it means that traders have already taken action and has already taken profit, has already taken loss if they lost, and they're done with it. They left this stock. There's a chance that it makes another move in future, but if you see this trend and the volume diminishing, the volume size here going down, you can see that traders around this time in the morning, 9 a.m. in the morning, have made a lot of move on it, and then gradually lost interest, and the volume faded away. So around the best time for this stock to go in is after making this move, because you never know. You don't see the future. If you're here, you don't really know if the stock is going to make this move. But if you're here, again, you're at $2.76 since the beginning of the morning, or since the market open. You've gone from 260 to 277. That is by itself 10% or 5 or 6% increase. Even if you get in here, which is more than 10% increase since yesterday, there's still activities going on here. See, the volumes is pretty high here. So even this time would be a good time to take action against this stock. Regardless, what we want to teach you is, in this slide, is not the right moment to go in, is basically the tool by which you can scalp a few cents off of this stock. So what we're going to do, we're going to go and buy, but buy custom, buy with OCO bracket, which is an OTO, OCO, a type of advanced order. One triggers another and one cancels another. You will activate this purchase. In this case, you want to buy 200, 300, 400. So I want to buy 1,000 shares. And at the same time, once I buy it, I want to make sure I sell 1,000 as well. So I will activate these, the quantities, the volume of my purchases. And then here, I don't want to buy with the limit. I want to buy with the stop loss, or a stop limit in this case. Currently, the price is at $3.17. Let's say that this stock is going to make another explosive move. What I will do is that I will go and say, once this stock reaches $3.24, which is one step higher than the current price. I see, if you notice, this is exactly the opposite of a stop loss. This is a stop loss buy. So in the stop loss sell, we go below. In the case of our Apple example, in a stop loss buy, we go above. $3.24 is the price I want the trigger point to be sent to my broker. And I want to get in a little bit higher than my trigger point, $3.26. Why? Because I don't want to be too tight to $3, too close to $3.24. I don't want the gap to be too tight, because my broker may not be able to fill the position if high volume of traders get in. So I will go a little bit higher so that my brokers will have an opportunity to fill my position. In this case, as soon as the stock explodes above $3.24, the trigger point will be sent to my broker, and the broker will have 3 cents gap to be able to fill my position at $3.27. Once the purchase is done, then I want to quickly take profit. This is my take profit sell order. The sell order, what I will do is that, how much profit do I want to have? $3.27 I will buy, and $3.33 I want to sell. However, I want to stop my loss if for some reason my calculation doesn't come to fruition, and I would sell at $3 and say 5 cents. If I go in at $3.27, and I want to make sure that I sell at $3.20, say 5 cents, or $3.24. This way, I will create a 3 cents gap between my point of entry for my loss, which is $3.03 loss times 10 times 100 shares. That's $300 loss. But my winning gap is the distance between my entry point, $3.27 and $3.33, which is 5 cents. That'll give me $500. $500 against $300, which will give me a relatively good win to loss ratio. So this way, if I implement this, first of all, with my purchase, I will capture the explosive stock. Then immediately afterwards, the computer will place an order for me for taking profit, or, God forbid, stopping loss if things go wrong at $3.24. All these activities, when a stock is exploding, all these activities will happen in a matter of seconds. You don't really have time to buy and then set these parameters, do your math on your profit and loss, and place your OCO order. You don't really have time to do that. So you need to do the homework in advance and make sure that these things are automatically implemented and executed by computer. If I hit confirm and send, you will see that my stop loss buy, which by the way got filled because my broker is I have a delayed data here because I'm using a paper money or simulated trading. Anyways, if it didn't get executed in this case, you just saw the green line and the green mark here, which showed my point of entry, and now I would it will fall between these two brackets. If it explodes above this, then it's going to hit this line, and I will take profit. If it goes down, it'll hit this line, and I will incur loss. But my win to loss ratio is always positive and greater than 1, basically guaranteeing if I make the right choice, if I pick the right stock, at the end of the day, if I make 10 trades a day as a day trader, 5, 6, or 7 of them, or even half, even if I were successful half of the time, because I maintained a positive or a more greater than 1 win to loss ratio, at the end of the day, I'll be left with money. Okay. I hope you've enjoyed this exercise, this workshop that we did together. If you have questions, just leave comments underneath this video, and we will make sure that you answer these questions through YouTube. It's a very good place to answer the questions and to answer questions by you guys. And don't forget to subscribe our channel and stay in touch for the next video. This is basically the end of Basic Series Part 1. And we will have a Basic Series Part 2 and an Intermediate Series, Advanced Series, and Day Trading Series, which we will go through day trading in details. We'll have multiple workshops in particular discussing day trading techniques for folks who are interested in day trading. And hopefully with watching this will give you guys more instruments and weapons in order to battle all these fluctuations and volatilities in the market. Thank you very much and have a very good day.